We talk about shum through cycle, and it's things are great. Capital comes in, oversupplies, gets tough, goes bad. What I would say is the bad part of that cycle has broken. It never came out of it starts to recover. So that's what you had for an extended period of time. Difficult environment didn't change. Instead, you had right sizing of businesses, downsizing, consolidation, and then when the recovery didn't happen, that happened again. So the process has gone through, and what you really have in a lot of industries we think are structurally changed today. And therefore, cyclical commodity businesses in certain cases are no longer that, or at least for an extended period of time, aren't going to get into the same trap in terms of a cyclical economy. In the meantime, the stock's traded at very low multiples. People don't want to own them because they think that it is a cyclical business. It's not. And then therefore, you could buy single-digit PE, strong free cash flows, all the things that you would want. So a Graham-type stock, but because of the structural changes in those businesses, we think there's barriers to entry and a lot of different things that Buffett talks about, a better business. So better businesses at discounted prices, and that's what it is. Those companies in a very different structure, given an extended down period, and yet that change have pricing power. And that pricing power is sustainable. And that's why we think also inflation, in large part, in many cases, is sustainable. It's not a supply chain issue, it's a supply issue. They've right-sized supply to meet end market demand and have pricing power. So that's a key, and that's what we're saying is that's old economy stuff that people don't think of. They think as all commodity businesses have structurally changed, they're in a different position today, and they're reaping their reward, getting high returns on capital, having pricing power, and sustainability in that profitability. So that's the concept of why we're saying revenge of the old economy.
Well, it's probably most clear to people who are following the market in the energy sector. That's where this revenge of the old economy is being felt basically everywhere, whether you are a consumer or you are an investor and you're seeing the energy sector basically outperform just about anything. Josh is really the guy who has captured this revenge of the energy sector the most. So Josh, I want you to kick it off with the energy sector.
Sure. Thank you all for coming to this, and thank you, Kuppy, for having me here. It's a little intimidating, so Kuppy has called many different inflections in various industries and asset classes, including cryptocurrencies and so on. So this is a little intimidating, and honestly, it's a little scary as a cyclical investor. Like Bob was saying, there have been many years of really tough times, and so I remember the last time that oil was popular and that energy was profitable, and it's a little scary thinking about what it looked like the last time an audience was interested in listening to me. And so, I think this time is different, and again, those words are terrifying also. So we've got the people interested in oil and energy and what I have to say, that's terrifying, and then this time is different is terrifying. And the counter to that scary stuff is that there's just not enough oil production capacity, there's not enough natural gas liquids production capacity, and there's certainly not enough natural gas, and then I'm less of an expert in this, but also coal. And so here we are in April, and natural gas is over $7 an MCF, and oil is over $100 a barrel. And no one that you would have talked to a year ago would have told you that gas was over $7, and almost no one was crazy enough besides me and Kuppy and maybe a few other people to publicly talk about $100 plus oil at that time. And so many of the factors that Bob talked about are very real. There's been underinvestment in oil and gas, in exploration, in delineation, and in development. There's been misrepresentations about production capacity at OPEC, non-OPEC countries, in shale in Canada, many other places. And then there's been an evisceration of the services base, which we'll hear more about, as well as downstream. And so there's just not the ability to ramp up, even with the economic price signal that you would normally see oil supply and natural gas supply ramping at current prices. And so you need the services companies and the other sort of input companies that would allow oil producers and other cyclical producers to start ramping up. You need them to start investing, and they're not investing yet. And so when you look at the history of these cyclicals, there's never really been a cycle like this where there's the price signal and there's not the investment. So maybe we have ESG to thank, like Kuppy's talked about. Maybe we have other sort of this long negative cycle to thank where people just don't believe that this will last. So it's unclear exactly which particular factor is the biggest one, but that combined setup is very promising for oil. We've got this $250 WTI hat. I don't know if this is a prediction, but it's a nice hat. We have this really nice setup with potential for further re-rates, both on the equities as well as on the commodities.